Have you ever wondered if there's an easier way to find the most profitable stocks in the market? After analyzing over 50,000 stocks a year, filtering through endless charts, and studying price action patterns, I discovered one thing that changes everything. It gives me an edge, which every good investor must have. It allows me to spot opportunities before the crowd, so I get in early and then use the momentum from the crowd jumping in to maximize gains. And so if you want a portfolio that consistently performs and compounds over time, then listen up. Okay, let's cut to the chase. Stock picking is frustrating. Did I find it frustrating? Absolutely. I was at a point in life where I would have found holding a sneeze for the rest of my life less frustrating than never being able to pick good stocks. I feel your pain, but I've got you covered so you too can have the most satisfying sneeze of your life. To make your investing journey 10 times easier, here are the key lessons I've learned that will help you identify the best stocks and avoid the ones that drain your portfolio. Now, what started out as sheer determination has laid the foundation for what is a straightforward and efficient way to handle a large number of stocks and systematically filter down to the very best. What was the main overarching lesson I learned by analyzing thousands of stocks daily? Well, this lesson actually answers an important question, which is, what is good investing? The answer is often not what you think. Pattern recognition. The most profitable patterns being long-term trends, and trends repeat often, but they're sneaky and cheeky. They won't give it up easily. They want to be found. The good news, once you've seen the same setups and trend patterns play out over and over again, decision-making becomes second nature. There's one thing that stands out the most when scanning through all these charts. One major signal that tells me a stock is about to make a significant move. What is it? Consolidation. That annoying period where a stock moves sideways, stuck between two price levels for an extended period of time. It could be weeks, it could be months, it could be longer. Now, hear me out. Are you just a sack of skin holding some bones, or are you a miracle of life with endless potential? Well, in reality, you're a bit of both. A consolidation is more than just a collection of candles going sideways. It's so much more. But it's a period when investors get frustrated and ultimately walk away. They see unpredictability and get the heebie-jeebies. I know that feeling, but looking at 50,000 charts daily, as you would expect, changed everything. Now I see a potential opportunity brewing whenever I see consolidation. Here's how I use tech to my advantage. I use a scanner to find all the stocks breaking out from a consolidation market that lasted at least 3 months. Using our custom developed charting tools, I can quickly identify stocks with strong performance histories that look promising for my portfolio. I then use these tools to identify the high of the consolidation zone and set an alert on the stocks I'm looking to take positions on once they break through the consolidation high. When the stock confirms a breakout, the odds are in our favor for a large, profitable move. And because I've set my alert, I've not had to stare at the screen waiting for the breakout, and I'm also positioned right at the base of the next major uptrend. Sweet, right? The next thing I learned from all my analysis is the concept of reset points in the market. When a stock trends strongly for a long time, it's only natural for a correction to happen. Most investors panic. I don't. Not anymore anyway. I wait for the stock to pull back to its 200-day simple moving average, the ultimate reset level. Now, I'll be covering how to exit from a winning stock shortly so you can lock in as much profit before the stock drops back to the 200-day simple moving average. But time and time again, high growth stocks use the 200 simple moving average as a launch pad before resuming their uptrend. Spotting this setup means I can enter at the right time, just before momentum kicks back in. Getting in at the start of a strong trend is crucial for making as much profit as possible by doing as little as possible. Okay, now let's go through the anatomy of stocks that keep winning. We can agree that not all stocks trend and move in the same way. Some are volatile and don't trend very well. Some trend, but very erratically, making them an uncomfortable stock to hold. But some form beautifully linear uptrends, and these are the ones all good investors must be able to identify using the techniques I am sharing with you. So, how do you spot them? Simple. A pattern I repeatedly detected from winning trending stocks was that they consistently bounce off the 20-day simple moving average as they rise, and they do this for weeks and months at a time. Here's GoDaddy on the daily time frame doing it. Fiserv is another very good example of a trend bouncing off the daily 20 simple moving average. And here's Nvidia, which has a solid history of using the daily 20 simple moving average as a support level. Now, based on this understanding, we developed a proprietary indicator called the Linear Trend Indicator, or the LTI for short, that confirms this for us. When the indicator remains below the black horizontal line, it means the stock is forming a sustainable linear trend. This indicator tells us there is directional volatility in the stock and that the pullbacks in the trend are of the same size, which is another very good sign of a top stock. This means holding the stocks is altogether a far more pleasant experience. If you focus on stocks that respect these parameters, you align yourself with the highest probability opportunities, which is our goal as investors. So we know why and how to use consolidation to identify the start of a trend, and we also know the anatomy of a winning stock and what its trend structure should behave like. So let's switch our attention and focus on how to exit from a winning stock, and well before it completely reverses. Making money in the stock market is that sweet spot between picking and investing in the right stocks, and then knowing how to exit from these stocks. After consistently analyzing 50,000 stocks daily, I narrowed down to two main ways of how to identify when a stock's trend is about to reverse. The first is tracking how price behaves around major resistance levels. If a stock struggles to break through a key level after multiple attempts, momentum is potentially fading. We have developed proprietary tools that identify and mark these key resistance and support levels for us based on price structure. These tools not only save us a lot of time drawing support and resistance levels on the charts manually, which a lot of traders do, but they also help pinpoint these exact zones as they form in real time. The second is an obvious change in trend direction. If a stock stops creating higher highs and higher lows and instead repeatedly starts making lower lows and lower highs, particularly when finding resistance at the zones I mentioned earlier, then it's time to execute our exit strategy and lock in profits. Here's another pro tip I have learned from analyzing 50,000 stocks daily since 2007. To avoid emotional exits, I use a trailing stop strategy. And to show precisely how I do that, my preferred method of trailing stop loss is to use the volatility of the asset to create a stop loss unique to the stock. We have created a tool for this too, as it shows precisely where to exit. No guesswork or uncertainty, which is usually the exit strategy for most traders and investors. But if using the volatility is a little too advanced at this stage, then you could use, say, Donchian channels, which works in a very similar way. The point being that you want to use a system that lets the market dictate the exit rather than fear, hope, or greed. Our trailing stop loss, when combined with understanding support levels, keeps us in winning trends for 12 to 18 months, often much longer. For example, we've been holding Fiserv for a year. You can see how the stock has never broken below the TSL. A good TSL prevents you from being stopped out on normal volatility or pullbacks in the stock, and instead gives the stock plenty of space to unfold. Most investors lose money because they chase hype, jump in and out of trades emotionally, and treat investing like a get-rich-quick scheme. That's not how I do it. I follow a trend-following approach, one that prioritizes consistency, risk management, and long-term compounding. Investing can certainly feel overwhelming when you're just starting out. The good news is you don't need to analyze thousands of stocks to be successful. We've already done that hard work for you, but you do need a simple, proven weekly process to make consistent profits for your portfolio. Watch this video to learn how the process works and how you can use it to grow your own investments.